welcome back, ladies and gentlemen, to Enterprise Group's channel, excelling at specialized equipment and services to build out the infrastructure and energy pipelines and construction. Joining us, we always have the pleasure of Desmond, the Vice President here. Welcome back, sir.
Hello, how are you today?
Oh, living the dream as always, and I hope you're doing just as well, especially with that last interim you guys dropped that I wouldn't mind diving down into here today. I guess we should kick it off first and foremost with your revenue and gross margin. I mean, from the last quarter of, or the first quarter of last year till now, I mean, you guys went from 2.7 million to 3.5 million on that gross margin. You want to give a little bit of clarity here into those revenues and that bottom line? I mean, you guys are really doing well in this current market environment.
Yeah, what I could say is, and we've talked about this once or twice here on previous interviews, but it really started midway through last year. I talked about, that trajectory sort of forming itself. We saw, Q3 and Q4 started to develop itself. This Q1 really confirms that revenue growth trajectory that we spoke about. And of course, I've talked a little bit about we've had the opportunity over many years of a very soft energy economy here in Canada. We've been, right-sizing everything, really finely tuning all the operations. And when you get a mix of, better pricing, because we've been able to, because of the demand, increase some pricing on our equipment, and of course, higher activity levels against that backdrop of really tighter operations, you start to get this increase in margin, and it's really starting to develop. I think it really is no mistaking itself. I mean, yeah, we talk about the revenue increase on the same period, up 30%, gross margin from last year, 33% up to 46%. These are nice increases for ourselves. Nice increase in EBITDA as well, from 25% last year up to 40%. But we're really proud and happy to say that the earnings per share is back in a pretty good form. Earnings last year was right around 100,000 net after, and of course net income is 22%, and almost 1.7 million on the quarter. So we're delighted with the quarter. It sets in a nice tone for what we do expect for the rest of the year, which is, we're in Q2 now, and Q2 in the services business is the quarter where we go from winter to summer, and we get the thawing of the ground out in the frontier, and it's hard to get heavy equipment around. So Q2 is the lower quarter on the lowest quarter on the calendar historically, but we're glad to say that activity levels are really good, and we're anxious to get a Q2 finished here at the end of June. But the outlook into 2023 looks promising, and that's the result of the new drilling forecast that came out a couple weeks ago, which again increased again. So we like our position. We like where our clients are, and one day at a time.
Yeah, I really appreciate those clerical insights. I really feel like you guys are one of the few exemplifiers that, some stocks could still perform well in the volatility of this market. And just diving a little bit farther in here, I mean, you guys are fairly robust from a balance sheet perspective as well, right? 53 million assets, over $1 million in cash against 19.4 million in liabilities. Want to give just some quick insight into some of the liabilities and perhaps the cash spend moving forward here?
Yeah, certainly. So what makes up a good piece of those liabilities, of course, is our debt facility, which is just under 11 million. We do own some primo property in there that's valued a little over 4 million, and 2 million worth of mortgages against that. So all those assets are right side up and so forth. It's important to note that our debt facility is our asset-backed facility, as well as our accounts receivable is in that number. So it's not like it's an asset facility and then accounts receivable is on top of that. That's all in that 10.811 million figure there. Obviously, we're an equipment related service company, so we do have a fleet of vehicles. So you'll see in that mix the lease. The leases on those vehicles would show up as a long-term debt. And of course, in those properties that we have locations with today's IFRS type treatment and so forth. When you have a 3 or 5 year lease at a premises, that counts in that long term debt figure. So if you skinny things down to really where the hard debt is, we're right side up in a big way. I mean, if you look at our payables, which are on that quarter 2.5 million, supported by 6.4 million in trade receivables, so you can see how right side that up that is on the income and balance sheet.
Yeah, and it's probably giving you a lot of controllables too, right? Because you're getting a good return on these assets, and a lot of them are sitting in and cash flow, or like you're saying, property type investments there. So you're in a really fascinating place, and I look forward to seeing this story continue to evolve. Desmond, thanks so much for your time today.
Thank you, Kyle.
Always a pleasure. On that note, I want to pass the question out to the viewers. We'd love to know what you guys think about all this in that comment section below. Consider subscribing. As news comes down the wire, of course, we'll continue to update you here. But on that note, stay cool, stay awesome, and as always, I look forward to catching you in the next one.